Okay, in this last video, let's go ahead and wrap up the look at working capital management, and we'll pick up here with looking at the fact that RR is likely holding too much inventory. If we look at their inventory turnover ratio at 10.8 times, it's much lower than the industry average of 20 times, and so this suggests that the firm is carrying much more inventory than the sales that they're generating, that they're being inefficient with their inventory management. And in fact, as we look at other things, we'll see just all of the current assets and all of the working capital. It appears that the firm is being inefficient with the management of that. Let's move on to the next slide here and look at inventory management. How we measure that. If they reduced their inventory without adversely affecting sales, what effect would this have on free cash flow? Well, in the short run, a one-time reduction in inventory would cause an identical one-time increase in free cash flows. So every dollar that is reduced in inventory, every dollar that inventory goes down, that's a dollar that cash flow increases, free cash flow increases. And if we can do that over the long run, then that kind of systemic change is going to be an ongoing free cash flow change year after year. And so the value of the firm is going to go up by virtue of that improvement in efficiency. So one way you could talk about this is that an improvement in free cash flow and an improvement in working capital processes is a gift that keeps on giving. So it's going to improve the free cash flow year after year, and that's going to improve and increase the value of the firm. In looking at credit policy, we need to look and see whether the customers of the firm are paying more or less frequently than the firms of the competitors. So we can do that by looking at the day sales outstanding ratio. Again, this is the receivables over sales per day. In this case, the firm has 45.6. The average firm in the industry, or the industry average, is 32 days. So the firm has well above average receivables, which means that they are collecting much more slowly than their competitive firms, and so their customers are paying less promptly. And one thing that the firm should do to kind of manage that, control that, is consider tightening its credit policy. That would look like requiring firms to pay more quickly, starting to charge late fees for payments that are missed or not received within the 30 days, if that is indeed their policy. Do other things. Maybe there's more frequent calls, there's more stringent collection efforts to get those receivables paid on time. But regardless, the firm, in order to manage their receivables more effectively, need to make some changes to bring that number, 45.6 days, more close to the 32-day average of the industry. So let's move on here and look at some elements of credit policy. One aspect of it is to offer cash discounts. And so this would lower the effective price for customers who are paying in a timely fashion. This might attract new customers, and it's also should give incentive to reduce the day sales outstanding. So you'll have more customers either paying with cash to take the cash discount, or if there's also a cash discount for any receivables that are paid off within a certain period of time, like 10 days, then they would receive that same discount, and that would also help reduce the day sales outstanding. So a frequent way that credit sometimes is offered is like a 210 net 30 policy. So this would mean a 2% discount on purchases if it's paid off within 10 days. Otherwise, everything is required to be paid off within 30 days. So a 210 piece is going to offer a cash discount, or at least a discount if the purchase is paid off within 10 days. So it's not necessarily a cash discount per se, but it's like that, and it's going to help reduce the day sales outstanding, reduce the receivables. And that will benefit the firm. If they're carrying less receivables, that means they don't have to finance it. That means their free cash flows are higher. That means the value of the firm is potentially increased. Another thing that the firm could change or effect is the credit period. So how long to pay? That would be this piece right here that I just mentioned, the net 30. That is saying that customers have 30 days to pay. That is going to be really a function of the industry and the types of goods that firms are selling. In some industries, it might be very well customary that 4 to 5 months is the frequent time to pay off purchases, and so that's 120 to 150 days. So it's definitely not a default that it's 30 days, but that's perhaps the most common. Regardless, if a firm shortens the period, that's going to reduce the day sales outstanding. It should reduce the average receivables. The downside of that is it may discourage sales, especially if you are departing from industry norms. So as I mentioned just a minute ago, perhaps you're in an industry that has 4 to 5 months as kind of the typical credit period. And if you try to change that markedly, maybe you say, we're going to do 2 to 3 months, you may lose sales because customers might go to competitors that offer more generous terms. So the credit period would definitely need to be within kind of the realms of the competitive set that a firm is operating in. Now, again, in looking at this particular company, RR, the fact that their day sales outstanding are 45 and the industry average is 32, there's not much fear here that they are not being competitive, that they would discourage sales by tightening up their credit policy. If anything, they should have much more sales, but we're not really seeing that flow through on the income statement. Another thing that a firm could do to change their or affect their credit policy, to look at tightening their standards, that's going to help both reduce bad debt losses, and also it should help reduce the day sales outstanding. The downside again is that this could reduce sales for marginal customers. They may be less inclined to buy, or in fact may be unable to buy. They may not reach or meet that minimum credit threshold for the firm, and so they would not be able to buy on credit at least. And if a firm needs to buy with credit, then they're going to have to go elsewhere. But the good news is, if there's fewer bad debts, that's going to reduce day sales outstanding and ultimately help the firm, again, improve value. And then lastly, the collection policy. We can have a tougher policy that would help reduce day sales outstanding. That might mean we have more frequent calls, more frequent requests to the customer to pay in a timely fashion. There may be late charges imposed, maybe other kind of penalties imposed on firms that aren't paying in a timely fashion. The downside of that is that it may damage customer relationships, may make it more challenging to continue selling goods and services to those firms that you're all of a sudden being tough with. So does RR face any risk if it tightens its credit policy? Well, definitely, because a tighter credit policy could have the effect of discouraging sales. Some customers may choose to go elsewhere if they have to pay their bills sooner. Now, it's kind of tricky to say that in this particular context, because the average day sales outstanding for the industry is 32 days, so about 13 days quicker than what this firm is offering. But it's possible that just because the firm is being more aggressive with their collections, it could send people elsewhere. And then some customers may not be able to buy because of their poor credit. So if we raise the standards, we again may lose some sales because of poor credit. Let's keep moving here to try to wrap this information up in this video. If RR succeeds, if the firm succeeds in reducing days sales outstanding without adversely affecting sales, what effect would this have on free cash flow? This is very similar to the situation we talked about with inventory, where in the short run, we might have we would have a one-time reduction in days sales outstanding, and that's going to cause a one-time increase in the free cash flows. There's kind of a dollar for dollar trade-off there. If we reduce day sales outstanding, and really that's receivables. If we reduce receivables by $500, that's going to increase free cash flow by $500. In the long run, if sales grow and day sales outstanding remains at its new lower level, I should say, so the level has gone down because we've improved our receivables management, then future free cash flows each year will be greater, and that's going to help the firm both in terms of free cash flow and in terms of value. Right, because ultimately value is a function of the free cash flow that the firm generates year after year. All right, let's move on to accruals management and the accruals policy. So everything else being equal, a higher level of accruals is going to increase free cash flow. So firms are kind of desirous of having higher levels of accruals. They are free in the sense that there is no explicit interest charged. So the things like accrued wages, there's no interest charge, that the employees are not charging a firm for the fact that they aren't getting their wages paid for each day that they work until the end of the pay period, whether that's every 2 weeks or every month. But firms have relatively little control over the level of accruals. They're going to be influenced by industry custom, economic factors, economic laws, tax laws as well. Not really economic laws. There could be other laws, labor laws, that would affect the ability of a firm to change their accruals markedly. Let's wrap this thing up with looking at trade credit policy. So trade credit is the credit that's furnished by a firm's suppliers. So that's whenever you're buying on credit, that's whenever you're generating payables, accounts payables. Trade credit is often the largest source of short-term credit, especially for small firms. So this is where it's difficult for a firm to get a bank loan. But most firms, even if they can't necessarily get bank credit, they can usually get credit from their suppliers. Again, from a supplier standpoint, it makes sense because you're making it easier for your customers to buy your goods and services. So you want to offer them credit to the extent that it's going to help them buy your stuff. And of course, to the extent that they can pay for that stuff eventually. Trade credit is spontaneous. That means it kind of changes with the sales of the firm. As sales increase, typically purchases will increase. You're going to increase those spontaneous current liabilities like accounts payable. It's relatively easy to get, but the cost can be high. We'll look at this in just a second when we look at this trade credit example. If you're foregoing discounts, cash discounts, then it can be very costly indeed. Yeah, we're just going to look at a quick example here in the next slide. A more complete discussion is in the text. And really, it's not something I want to focus that much on. I just wanted you to have the big idea that's brought about by this next slide, that trade credit is not necessarily free if you're taking advantage of it. If there's discounts that you're passing on, that in fact can be very costly. So let's wrap up with this example real quickly. Assume that RR is buying $200,000 of materials, and then what we're saying here net. The net term is indicative of after any cash discounts that the firm is receiving. So if they're buying this $200,000 net, with terms of 110 net 30. Again, this was indicative of a 1% discount if it's paid within 10 days, and then everything is due within the 30 days. So we can find out what the cost of this trade credit is. So let's look at how we would do that real quickly. The net daily purchases, we take $200,000 divided by 365. So every day on average they're buying $547, let's call it $548. This would be the cash price. So if they pay within 10 days, that's what they would receive, the price that they would receive for the goods that they purchase. So they would be buying it at $548 per day. So their total purchases are really the $200,000 after they get that 1% discount. We would divide that by 0.99 to gross up the purchases. It turns out that those would be $202,020. So this would be the price if they don't take the discount. That is, if they are not paying cash or not paying within the 10 days. So what does this mean? Well, the difference between the $200,000 net and that $202,000 gross is what they're paying in effect to have their suppliers provide them financing. So that $2,000 is their dollar cost of the financing, and that's every 30 days. That's just for 30 days of financing. So we're going to wrap up there. That takes care of working capital management, and we'll pick up with the next topic in the next set of videos, and I will see you then.